We'll talk about the factors at play in markets with Saibal Ghosh, who's joining us now, right in the studios, CIO at Aegon Life. Saibal, good to have you back on the show. I must congratulate you on your call last time when we spoke. Since then, midcaps did very well, and so did some of the calls like consumer tech, etc. But let's start by our conversation with the call on midcaps. Now that your fund includes and the space has done so well already, and a general consensus is that from here on, it's the large caps which will outperform. Have you started trimming or taking profits out of those calls in the mid cap which did phenomenally well?
We have. In fact, if it is a mid cap fund, obviously by default you have to take mid caps or small cap for that matter. But wherever we have the flexibility, we are definitely taking out profit because the gap is now uncomfortably large. While we understand and we recognize the fact that the earnings in mid cap would be much superior than large cap going forward, but even that notwithstanding, the valuations are looking stretched on the mid cap and small cap. So yeah, it's the time to shift to large cap, and we have started that.
I was also checking out some of the large cap banks which didn't do very well, like HDFC. Just taking an example, in the last 3 years, now seem to have gotten back, and you have some of the large private banks. Private versus PSU bank, what is your thought process on each of them? Because numbers are equally good if you talk about large cap PSU and of course private, but valuation is slightly on the lower side in PSU. But you still favor large cap private ones?
I mean, it's not large cap versus mid cap when it comes to bank. It is more stock specific. We have some exposure in some select mid cap where we have the valuation comfort, and we are holding those banks. Some small cap, in a sense, a little smaller private sector banks also we are preferring where they have proven execution track record. In large cap, yes, select rather large cap banks we are overweight. Yeah, that's where we are. But overall, our stance on bank is neutral.
Okay, so what's your big call right now on interest rates, especially, and the relationship interest rates actually have with markets? Because even the data from US is showing that perhaps mid next year rate cut cycle may start. Early signs perhaps here also mid of next year. So how will interest rate and equity valuation relationship pan out in your view?
No, it does. I mean, obviously, earning multiples and we have seen a very close relation between earning multiples and interest rates, and that is definitely going to play out. But at this point of time, I think the bigger factors are playing out, which is the capex cycle turning around after more than a decade. That's a big play, and we are more positive on that segment. On the interest rate sensitives, I think to some extent it has played out through NBFCs and real estates. But yes, there are further play left. But as far as the interest rate cut is concerned, I mean, are we taking a call that interest rate is going to come down big time from here and accordingly structuring our portfolio or constructing our portfolio? The answer is not yet. Not yet. But yes, one good thing is that the visibility to end of rate hike cycle is now visible. That's a positive thing. But we may have to settle for higher for longer.
How did you analyze Governor Das's commentary this time, which to us appeared pretty dovish because of raising growth estimate, bringing down inflation estimate by Q3 of next year 4.2, and even saying that there are early green shoots in the part of the economy which is not doing very well, which is rural?
Yeah, in fact, one expectation is that at some point of time, RBI will change its stance from withdrawal of accommodation to neutral. Because unless RBI change its stance to neutral, we cannot expect a rate cut scenario emerging. Because the moment it is neutral, it means that the rate action will be dependent on the data. But at this point of time, as long as they are continuing with withdrawal of accommodation stance, no matter what the data is talking, is not going to cut the rates.
Okay,
so yeah, we are waiting for that.
In this kind of a scenario, India macro is doing well. Global macro is looking weak, but it's working in favor because it brings down crude oil prices. And of course, so much of underperformance on equities under the belt already. The 12 to 24 month outlook on equities, one should be slightly moderate in expectations, or you think a good case for healthy returns even from here?
Look, Ajay, the problem is that at this point of time, no convincing downside is visible.
Okay.
Which is where the discomfort is, because if it is not convincing downside, you don't price that risk in your valuation. That itself is a risk. But having said that, in fact, we are personally, I am very, very positive on market at this point of time. In the sense, despite the fact that quite a bit of rally has taken place, but I think the big picture is that we are reaching to a tipping point. From here, the things can go up big time. Let me try to illustrate it by an example. It's just a data point, little technical, but also fundamental in the sense that scale attracts scale.
Yes.
Today in India, we have 30 mega cap stocks. By mega cap, I mean to say 25 billion US dollars and more. That's a very, very big number in the sense that today the entire Sensex, maybe a couple of stocks apart, is having a market cap of 25 billion US dollars and more. Now, in the entire Asia Pac, including developed Asia Pac, which includes Australia and Japan, Australia and other countries, the only two countries where the mega cap stocks are more than ours is Japan and China.
Excellent.
So today with 30 stocks, if you are having, and why it is significant, because for a whale investors or a global fund managers, a 25 billion is basically a threshold. Beyond that, they start constructing the portfolio for meaningful alpha, given their size, right? And with Sensex, the entire Sensex, if it is mega cap, the way the market is going, the ability of a global fund manager to construct a well-diversified portfolio is actually a huge factor. I mean, maybe it's not playing immediately, but I think at some point of time, these things will play out, and the scale will attract further scale.
Interesting. So you are making a case that FIs which are eluding us so far, two factors will work there. One, now we are offering more or bigger, adequately liquid names to participate in one, and plus China's appeal is actually diminishing versus us.
Besides, in China, China has got say 62 or 63 mega cap stock, but then if you construct a portfolio, it will skew to 2 or 3 sectors, right?
And plus also superior quality earnings, all of that.
Here you with Sensex, you see how diversified portfolio you can construct. That's a big thing. So I think these appeals are also definitely there, and if you ask me, and that's another reason why we would be little positive on the large cap at this point of time.
Yeah. So give us a flavor of additional weights. Where are you increasing your weights within the large cap side?
See, largely on the capex cycle related stocks.
But are you not finding industrial expensive?
It is expensive, but the fact is that, and I agree with you, that proxy to industrial play is not too many stocks. And that's where the scarcity premium will play out, Ajay. I mean, I know the valuations are stretched, but as a fund manager, we also have to recognize the fact that we are not a judge of what should be the valuation. At the end of the day, valuation is nothing but aggregation of market perceptions. Right?
Okay, I'll talk to you about one particular space. Now that we are talking about valuation, just a quick word on the way renewable space in India is within the power space. I mean, we just saw a recently listed company, IREDA, it went up 3x of issue price in 2 weeks, right? But you also saw REC PFC gallop a whole lot, NTPC, legacy power company, but still massive alpha, an entire power value chain. So some are questioning the valuations now in the power value chain side. What are your thoughts?
I'll not go stock specific,
Sure.
but definitely some of the power finance companies are actually a demand aggregator in the power sector, right? So the valuations, if you the stocks you named at some point of time in the earlier cycles, they went to 2.5, 3 times, the 2.5 times, right? So from that angle, it is. I personally feel that there is still some juice left.
You also talking about domestic manufacturing?
We do,
large cap?
yes, absolutely, absolutely.
So,
I know manufacturing as a theme is coming up. People, everybody is talking about it.
yes.
But I think when we talk about the capex cycle and infra and all the stuff, a bit of manufacturing always already comes in. We are also positive on two-wheelers, by the
So
way.
that is a part of. There are just 3 stocks, and they've come back after a very long time. I'd like to wind up our chat on another pocket of the large cap, which hasn't done a whole lot and becomes the favorite, whipping boy as well. IT and pharma. Pharma is still coming back, but what about IT?
I think there's a little bit of stress left.
Okay.
But there are some IT companies, again, stock specific, some IT companies are looking good, where the margins are low, change in management, all those stuff is there. But overall IT, we are still little short.
Okay, fair point. Thanks very much, Saibal, for joining us.
Thank you
on the
very
show.
much.
So the gist is that there is still more stress left in IT pharma kind of sectors, but domestic manufacturing, capital goods, two-wheeler stocks, and financials, private financiers, large private banks is something we should look at.